Hey everyone, so today we're going to dive into a pretty incredible story of financial transformation. And look, this isn't about some secret trick or, winning the lottery. It's a real 20-year journey that just shows how small, consistent habits can lead to absolutely massive results. So let's break down how it was done.
So this is where it all begins. At age 20, the starting line was exactly zero. I mean, nothing. No savings account, no investments, not a single penny put away for the future. And that's a situation a lot of us can probably relate to, right?
And then you fast forward 20 years, and this is where that journey leads. Over $500,000. I mean, the contrast is just wild, and it immediately brings up one huge question.
Right? How on earth does someone go from absolutely nothing to a portfolio that size? Well, I can tell you it wasn't through some crazy high-risk gamble or just a stroke of dumb luck. It was a clear, repeatable strategy. And that's what we're going to do here. We're going to break down the exact numbers and the super simple rules behind it all.
Okay, so let's actually walk through this 2-decade journey step by step to see how these small, consistent actions added up to a really life-changing amount of money.
The whole thing really breaks down into 4 key stages. You've got the very first step at age 20, then the growth phase that really starts kicking in around 25, then this incredible snowball moment at 35, and finally reaching a real sense of financial freedom by age 40.
It all started with just one simple, manageable decision: $100 a month. That's it. It was automatically invested into a basic S&P 500 index fund, which is just a fancy way of saying you own a tiny piece of 500 of the biggest companies in the US. No complicated stock picking. The idea was simple. You don't need a ton of money to start, you just need time. So after 5 years of just sticking with that $100 a month, the portfolio was worth about $7,300. Now think about that for a second. Only $6,000 of that was money actually put in. The other $1,300? That was pure growth. It wasn't a fortune, sure, but it was momentum. It was proof that this whole thing actually works.
Okay, now we're in the growth phase. With a stable job, the strategy didn't get more complicated, it just got bigger. The monthly contribution was bumped up to $500. And the key here is avoiding that lifestyle inflation, right? Instead of a fancier car, the focus was on investment inflation, just putting more money to work.
And this is where the magic really starts to become visible. Sometime in the early 30s, the portfolio crossed the $100,000 mark, and that is a huge psychological milestone. It's the point where you really feel that your money is working for you, 24/7, even when you're sleeping.
Now, in this final 5-year stretch, something absolutely incredible started to happen. The investment's own growth, the earnings it was generating all by itself, started to become larger than the new money being put in. This is that snowball moment. The monthly investment was bumped again, this time to $800, just to pour more fuel on that fire. And there you have it. By age 40, the result of 2 decades of just being consistent. A portfolio worth over $500,000. And it all goes back to that first, simple decision to start with just $100 a month.
So that's the story. But what was the actual formula? Let's distill that entire 20-year journey down into the simple strategy that made it all possible.
Honestly, it just comes down to these 3 rules. First, start early. Your biggest, most powerful asset is time. Second, stay consistent. You invest every single month, whether the market is up or down. This takes all the emotion out of it. And third, and this is so important, reinvest everything. Let every dividend, every bit of growth just go right back in to keep on working for you.
So the engine driving this entire process is something called compound interest. And all it means is it's not just your money making money, it's your money's earnings making their own earnings. The snowball analogy is perfect. It starts out tiny, but as it rolls down the hill, it picks up more snow, getting bigger and moving faster, all on its own.
Out of all the variables, there is one that matters more than any other: time. How much you invest is important, but when you start is absolutely critical. Let's take a look at the real jaw-dropping cost of waiting. This slide just lays it all out perfectly. Let's say you invest just $200 a month. If you start at age 20, you could have around $118,000 by age 40. But if you wait just 10 years and start at 30, that exact same investment gets you only $52,000. Less than half. That 10-year delay is unbelievably expensive.
So we've seen the journey, we know the formula. Now, let's bring it all back to you and the most valuable asset that you have right now.
This quote really just sums up the entire philosophy. Don't stress about trying to predict the perfect day to invest.
Don't worry about market crashes or booms. The winning strategy, time and time again, is just to get in the market and stay in the market. Let time do all the heavy lifting for you.
Look, the person in this story started with absolutely zero, and 20 years later, they had financial freedom. The principles are simple, they're powerful, and they're available to literally anyone. So the only question left is, if your 20-year journey starts today, where's it going to take you?